I can hear you through this.
There we go. We're going to bring in Greg Rand, and we've had a couple of technical difficulties here today. So let's see. Yeah, I should be able to bring you in right here. There we go. All right.
Hey.
So we decided to do a. Greg, can you hear me?
I can. Can you hear me?
Now I cannot hear you.
Testing.
What's going on here?
Hang on a second. I know.
Okay, I can hear you now, Greg.
So
you hear me?
I can hear you through both things. I'm going to hang the phone up.
Okay, perfect.
In theory.
All right.
All right, we good?
Yeah.
All right.
Okay, so we can hear each other.
That's awesome.
It's a little bit of an echo on my end, but anyway. So Greg and I were having a conversation this morning, and we were talking about the housing. We're actually waiting for a call that didn't show up, to be honest. But we started talking about the housing news, and just there's this sentiment out there and this fear about the economy and how it's going to affect the housing. So I feel like there are a lot of journalists who are trying to find a correlation with what's happening in the economy and how that's going to crash the housing, because that's big news.
Can you put that article up that you just had from CNBC?
Sure. Let's see here.
Let's illustrate as an example. So Noel and I have been having these conversations for more than a year. And we figured that, what will be fun is to go live on LinkedIn. And when we have these conversations, just sort of analyze them together and talk about it. So what do you got there? You got the CNBC
So
thing?
I've got the CNBC article. And so what's interesting is that, and nothing against, to be honest, sometimes I get a little aggressive with some of the journalists that write this, but it's nothing against a journalist, because they're taking data that they read and they're interpreting it a certain way. And the interpretation of that data is from a NAR survey, a NAR homebuyer survey that was just done. And let's pull that out first, because it's talking about, the question is, which I don't know, because it requires you to buy the report, but I don't know how many people they surveyed. And so they do these surveys, and this is always a question about data, about whether it's, quantitative data and it's qualified and all these different things. But
let me ask you, do you have the CNBC story up that you and I were talking about 5 minutes ago?
Sure.
Flash that thing, because I think it's really instructive. And what I want to do is just go about this where it's like, here's the data. The thing that gets very confusing is there's a lot of different metrics that get reported on housing. And very often the people that are analyzing it don't tell you what they mean. So for example, on this headline, signs point to a softer housing market. Now, they don't define what they mean softer exactly, but look at the key headlines, the key points. Just 12% of adults say they plan to buy a home in the next year, down from 14% in 2008. I've been following this stuff for 30 years. I don't have any hobbies.
Gross.
I've never seen this stat. What percentage of adults say they plan to buy a home in the next year? It's the first time I've ever seen that stat. So I look at that, and I'm just giving you guys like one housing geek's methodology of trying to size this stuff up quickly and see if it matters or doesn't. If it's a new stat I've never heard before, and CNBC is saying that something went down, I believe they went looking for something that went down, found a stat that nobody's ever cared about before. I throw that away, because I don't know if 14% is a high. I don't know if 12% is a low. I don't know if 8% is normal. This is not meaningful to me, so I move to the next one. The supply of newly built homes for sale falls 1% in the second quarter. I don't know if that's compared to last year's second quarter or the first quarter. Okay. Whenever I see anything I'm sorry, go ahead, Noel.
I was going to say, what's interesting is that, so if you read it, what it says the supply of new homes for sale fall 1%. So the supply, I'm assuming what they're trying to say is that the amount of homes that the home builders are putting out, because that's the supply of the homes, not how many are sold. And we deal with home buyers, our home builders all the time. We're dealing with them much on a very high level. So we're on a weekly basis, we're talking to some of the largest home builders in the country and the regional home builders. And, there's a lot of different reasons why maybe supply or what they're putting out there on a monthly basis may go down. I can tell you this, the home builders are putting out as many homes as possible. They are working at their capacity of what they think that the market can absorb. Now, what they've changed recently is focusing a little bit more on the lower income homes. And guess what? Some investors are buying those, but it's not necessarily, they're not competing with home buyers. It's just a fact that there's a need for housing right now. There is a shortage of housing all around.
But we have to honestly, we have to be careful if we want this to be credible to people that are watching, people that are in the housing business, giving anecdotes about how it's not as bad as they say. I don't think it's as valuable as saying, here's a stat that says sales fall 1% in the second quarter, whether that's compared to the first quarter or last year. Again, there's no baseline. It's 1%. And how that relates to the market softening, there's a disconnect there, because if supply is limited, which this is indicating supply is getting more limited, what that's going to mean is that all things being equal on the demand side, that's actually going to elevate demand. That's going to elevate home prices because there's less supply. And so a lot of what's been swirling around from these same media outlets has been this concern about affordability. This is not great for affordability because increased supply would tend to bring prices down, or at least have them level off or not accelerate as fast. So again, it's a bullet point that raises more questions than it answers. However, you got to acknowledge that 2 bullet points in a row, they gave you something dropping off of a number that you don't have in context, helping to paint the picture about the market softening. On to the third bullet point, prices of newly built homes have moderated. Okay, moderated after 7 straight years of increases, but sales are up less than 1%. So what does that mean? Sales are up 1%. Sales usually doesn't mean values. Sales usually means the number of properties selling. So in one bullet point, they've made a left turn from prices of newly built homes have moderated, which means they've gone up less than they did in the past. Again, making it sound like they've gone down, but they haven't actually gone down. They've just gone up a little bit less than they have in the past. And then boom, sales are up less than 1% annually. Compared to what? All right. So I promised you that I wasn't going to get into media bashing, but this is a useless story. It's a headline that was designed before they dug into the stats. The stats don't actually say anything. And the point that I want to make to people is that if you're making decisions on what to do with your personal wealth, or your business is in real estate investing, headline reading is like the worst thing you can do unless you know how to look at it and say, what do these numbers mean? How do they relate to the conclusion? In this case, they don't. They're there to support the conclusion. And so I go through something like this in about 8 seconds and realize that it's junk analysis and move on.
Yeah, I agree. And then I do get frustrated sometimes when you see the last 2 paragraphs are, well, why are builders not increasing supply of homes? They're facing rising costs of constructions. There's tariffs. There's labor shortage.
Hey, there you go. Wait a second. We just found the reason for the article. There it is in paragraph 1, 2, 3, 4, 5, 6, 7, 8. Paragraph 7. They are also facing rising costs of construction thanks to Donald Trump. Tariffs.
Right.
Guys, look, it's not a political statement. It's a completely objective statement. You don't know if I like him or don't like him. You don't know what party I vote for. I don't like media outlets who decided who they want to win the next election and then make up stories and game the stats in order to make the point that it's because we're fighting with China that the housing market's going into a slump.
Well, and so I'm looking at this Redfin, which I'm going to pull this up because I get frustrated when articles are based on interpretation of something else. The biggest decline in 6 years. So what is this? What newly home builds dropped 0.5% year over year. So why do they say 1%? That's what I don't understand.
Let me tell you what it is. Let me give you an analogy of what this is. You've got somebody in a rowboat and there's a storm coming and they're on the deep ocean and there's a lot of wind and they're trying to look at the droplets of rain to figure out which way the wind's going to blow, and the droplets are going in all different directions. Okay. They don't realize that they're actually connected to the Gulf Stream. So they're going northeast. No matter what happens on the surface, the Gulf Stream is going to pull them northeast. The Gulf Stream in this analogy is housing demand connected to population growth. Okay, so none of this stuff actually matters at all. What they're doing, obviously you can tell I get heated up. I promise I'm not going to, and then I do, because the next paragraph is lower mortgage rates could help on the margins. That's funny because mortgage rates were going up last month, they said, and that was going to kill the market. Now the rates are going down. That's not going to help the market except for on the margins. But the reason behind those lower rates, namely a growing fear of a recession in the U.S. economy. Well, who's the one who's creating the fear of a recession in the U.S. economy? These same people would tell you that if unemployment is zero, basically, if we're at full employment, if GDP is cranking above expectations, if the stock market is up, and if the real estate market is up, as evidenced by the fact that affordability is down because the prices have gone up, if every major indicator, retail sales, every major indicator is positive for growth of the economy, why do we have fear of a recession?
I agree.
One reason.
Well, a lot of it's about the global markets and the yield curve inversion and things like that. I think what's interesting in this is that these are 3-month moving averages that Redfin's using. So they're taking the last 3 months and they're saying new home sales are up 0.8%. The supply is down 1% quarter over quarter from the end of the year to, I guess, now, or the beginning of the year. But
gobbledygook.
Yeah,
it's gobbledygook.
So the supply of existing homes was up 1% in the second quarter, but the supply of new homes was down 1%. Like you could take snippets of this information and push whatever narrative you want. You could do.
Right, and you can make a lot of mistakes. So I'm buying property. I just bought 2 houses. I'm making an offer on another one tomorrow. I'm personally loading up because I've discovered a part of the Charlotte market that I really like. I think it's going to elevate. I know Charlotte's going to elevate. I know the U.S. economy is going to elevate. I wouldn't buy in New York and California because they're not, but I would buy in the Southeast and in the Midwest. And I think that if people, like I hear people, I post things as you do also on social media. I get headline readers telling me the housing market's going to crash next year. Housing market is peaked. But everybody that I know who has the data, i.e. all of our clients and all of our colleagues in the industry, what are they all doing? All the people that have all the real data and whose livelihoods depend upon executing correctly on what's going to happen in housing trends, what are they all doing, Noel? Say it with me. What was that? They're vacuuming the market. That's right, man. They're buying everything they can.
Yeah, apparently. Well, so that was a blender, part of working from home, and my daughter is making a smoothie. So
but that's the key point, though. Everybody that you know, everybody that I know is buying property. They're blending their portfolio.
Okay. Yeah. So sorry.
Awesome,
so yeah. No, keep going, because what's interesting is that when you start focusing on these higher end markets as well, which they talk about, this Redfin data is actually interesting. If you read all of the data, take it with a grain of salt and take it with some context, and realize that of course the markets that were overheated, Honolulu, Miami, San Diego, Los Angeles, West Palm Beach, San Jose, those markets are you can't point to those and look at those as what the rest of the U.S. market is going. So sorry for interrupting. Keep going on what you were saying on your point.
No, honestly, you've let me speak a lot. It's again, you want to go look at Honolulu, then you're going to talk about a micro market that has almost nothing to do with the rest of the national market. The important thing is that we're trying to help people make smart investing decisions. The housing market has been really, really stable. The last 20 years has been a really interesting stress test of the housing market. It passed, right? Because the market soared too high. It came down and corrected. It fought its way back. It's really in a good place right now. The only negatives in the housing market are the media reports. That's it. There is no negative data coming out of the housing market, which is why my larger point is those of us that have access to the best data and the most experience in housing are buying right now. Insatiably buying right now. Capital is flowing into the hands of our large clients because they're buying right now. We have clients who stop buying. Why? Because they read this headline? No, because they ran out of money and they have to go back and raise more because they bought everything they could and now they have to go out and get more capital because they want to buy. So
I think
I just hate to see people make bad decisions based upon what is really again, I could search. You could go back and look at these reports. When the taxes got cut 2.5 years ago, the take was this is going to be bad for the real estate market. When mortgage rates threatened to go up, this is going to be bad for the real estate market. They've been predicting a slump year after year after year since 2016. We haven't gotten one. The economy is only getting stronger. So listen, here's the point. If you're watching this and you're saying these guys are full of it, then you know what? You're right. We'd like to help you sell your portfolio. In fact, we'd like to buy your portfolio. Right?
Exactly. So again, to my point, you just want to look at the data, and I always want to go back to the actual source of the data rather than the interpretation, because what's going to happen, and mark my words, you're going to see off of this one CNBC article, several other articles written or op-eds, because that's always something that if you read closely, a lot of it's just an opinion. It's not a data fact-based off of this. And then it kind of turns into this snowball effect of everybody's writing articles off the other articles of a what I think is a misinterpretation of the data. And so the next thing you know, it becomes fact. And it happens in the news.
Well, you have to know for yourself. The point is we're definitely, it's a very inefficient situation that benefits the people that know what they're talking about. So if you know where, like, I encourage people, this is not a plug, but we have a free data set available on renterswarehouse.com. We have MLSs in 40 markets. You can go and look at massive amounts of data and actually see the way the market's performed. You can learn what the yields are in these places, learn what the long-term price performance, look at the population growth and the migration patterns and the employment data, and judge for yourself. The good news is that 5 minutes on that, and you actually do learn about the real estate market, and you have to know for yourself, because realtors don't really know the investment side of the market. They usually say it's a good time to buy no matter what time it is. So and because they don't look at it from the standpoint of the asset class. We understand it, but we're a very small minority. We're a new player essentially in the national scene. And any information you get from the media is, again, the headline was written before. Like, I assume if I go to Fox News, they're going to interpret this as good news for the economy. So it goes either way. You have to, before you read a story, look at who it came from. If it came from media that wants to see the president replaced, understand that you have to look at that with an understanding of the bias. Otherwise, you're going to be manipulated. If you want to see something where they like the president, want to see him get reelected, understand you're going to read some rosy things about the economy from those people. So I say throw them both out. Use these as nothing more than places where you can find the links to the CoreLogic data or to Redfin's data. Go and read the research, understand it for yourself, but just know when you're being manipulated and don't let it happen.
Well, and also understand that, we don't, and this is purely my opinion, we don't know what the new normal in the housing market is. There is, I had some people comment on my LinkedIn post recently about how we're promoting investors to buy, and it hurts neighborhoods and hurts local economies and all of this kind of stuff, which is false. But whatever that new normal is, you can't take what's happened in the last 5 or 6 years and use that as your baseline of the housing market, because we're in a recovery. And so I just, there's so many different things. So we're going to end this pretty soon, Greg, but let's talk a little bit about what we've been talking about as far as, our building out our brokerage and some of the exciting things we've been doing. I mean, we've been trying to build this SFR dream team we talk about. And the reason I want to talk about this is because it's relevant, and we're trying to get the word out. We're trying to get the word out to investors that you can sell your portfolios without vacating the tenants, and you can get a fair market value. We're trying to get the word out to realtors who focus in this space that you can have a home and you can have the tools that you need to work in this space. So you are very, very eloquent about this and passionate. So I'd like to just give me your spiel, and we can use this for content later on. We can use this for whatever.
All right, I appreciate it, Noel. I'll give it to you in context of the SFR Dream Team, as we've been referring to, which I think has a nice ring to it. What we mean by that is that there have been some sort of lone warriors out there, lone wolves running around the real estate market over the last many, many, many years that decided to focus on the investment side, but they got no guidance there or leadership or training or technology or tools. So I'm talking about the people that are real estate brokers on the one hand, real estate agents who participated in the gold rush when Invitation Homes and the other big players came in 2012 and started buying houses by the thousands, one at a time, but by the thousands. That gold rush, but also the guy that we recruited that I don't want to name yet because he hasn't given notice, but a top agent in a major metro just joined us because he had participated in that market and wanted to make his career around it.
Jeez.
Mailman there, Noel?
Man.
But then the conversation that we were about to have a few minutes ago, the meeting that got postponed, who is what you called, hey, Doggy.
I don't know what to do here.
I think we bring the dog closer to the camera. I want to see that dog. Bring him up. Come on, bring him up. Let me see him. You're not going to bring him up? Kick him out or bring him up?
Stella, come here. Come on. This.
See that dog.
It's okay. Nice. It's okay.
Okay, so he's getting tired of hearing about housing information.
Okay.
Long story short is we had a guy, this dream team thing is an open invitation. It's a big tent. The guy we're going to talk to that we'll talk to later on today, he is a turnkey provider, somebody who built a business buying dilapidated houses, fixing them up efficiently, putting a tenant in place and serving up a nice, clean, newly renovated, performing rental property. Those guys created a machine. A lot of them started management companies so that you could buy a property from them and they would manage it for you. Now they have hundreds or even more than that under management. They're getting tired of that business model. We were talking about this idea that the first decade of the big SFR run is now over. A lot of us played a certain role during the first act. We have figured out a second act. A lot of people are figuring out a second act. So guys from Invitation Homes are out starting Open Door, right? Guys from Waypoint Homes are starting Roofstock. Guys from Own America and Century 21 are now launching Renters Warehouse to a new level. Renters Warehouse Property Management launching an online portal and brokerage company. So everybody seems to be turning the corner in decade number 2 with a second act. And we're trying to open up a very big tent. We want every crazy entrepreneur out there, everybody who's got big ambitions, everybody who wants to play this as big as they possibly can and has some ideas, wants to avail themselves of the technology, the tools, the energy, and the momentum of a larger organization. I want this to be a collection of entrepreneurs. I want to feel like we're riding a team of Clydesdales with no reins, right? Just everybody pulling, everybody driving the business, capturing more and more of it. So we're trying to create an environment for people that are serious gangsters in the SFR world that want to come in here and blow their business opportunity sky high in a good way by joining forces with a bunch of other people just like them. So anybody who sees this broadcast and wants to hear more, we're not defining it really narrowly. We're trying to define it broadly and figure out what can work for different people who want to be part of the SFR Dream Team.
Yeah, I agree. And so I was one of those people, back in Chicago, I jumped into the real estate investing space, working with Invitation Homes and other investors. And I honestly got to a point where, when things started to die down, I didn't have a place to go, except I did because I stayed in this space. But I've been pretty unique because I wasn't a residential real estate broker before. I was a commercial real estate broker. So I also wanted to expand in the space. So that's why I started working with Investability and then Renters Warehouse. But my heart's always been on this side of the space of wanting to create this national platform that you can buy and sell single family rentals. And you can, since the day I came to Renters Warehouse, the question always was, why don't we start a brokerage? The time came and now we did it. And there is opportunity. And I keep saying this over and over every single time I get a chance. There is so much opportunity right now in the single family rental investing space. And there's so much enthusiasm around this space and so many investors jumping in and new investors and new money and old money and the barriers have been taken down. There's less friction. And so for those of you out there that that used to be in this space and have a passion for it, or kind of working in your niche market. And why I read all these articles before you do sometimes, Greg, is because I'm up in early in the morning and I'm going through LinkedIn and I'm searching people who have real estate investor and real estate agent in their profile. And I'm connecting with them and trying to let them know that the opportunity's here. So wasn't as eloquent as you, but I've been there. I've been in that position. I was one of those brokers, and I haven't seen this opportunity, and frankly, ever, because before, when it was the institutional funds buying, we're working off spreadsheets and you had to build these gigantic teams and there wasn't very many efficiencies, and
it's more fun now, man.
You had to, and trust me, and I know this, there's a lot of people who made a lot of money off the institutional funds. And there's a lot of guys who lost a lot of money because the funds put everything on the back of the agents. And if they zigged and you were zagging, you're screwed. Right.
And by the way, and it's worth noting that those initial pioneers, those dozen to 15 institutional funds that kind of paved the way, what really happened here was that the asset class was discovered as being a big opportunity because of the housing crisis, drew a lot of attention. Everyone realized that it had never been done on a large scale. Everyone realized that the data wasn't really there, the systems weren't there, the technology wasn't there, but we were in a mobile cloud environment. So for the first time, a lot of the obstacles that kept the single family asset class from evolving into institutional was the fact that it was scattered about and that it was really hard to manage. And a lot of people said it was impossible. But now in this era of cloud and mobile, and the desire for, a new asset class is a beautiful thing. A lot of people can do really well by making a name for themselves in a brand new asset class, which, by the way, single family rental is as big in scale as multifamily. So add up all the apartment buildings in America, it's about the same size as all the single family rental houses in America, and yet it's virgin territory. What's so interesting about it is that it's being different, especially in real estate, is so hard, right? The biggest challenge, I think about all the real estate agents that I know, I think about how many times I've heard people in real estate brokerage at the franchise level or the brokerage level talk about, forget 80-20, man, this is a 90-10 business. And they say it almost flippantly, like all these people that join the industry who then fail out of it aren't their responsibility or something, right? Like, hey, kid, here's your phone, good luck. I'll give you 90%, but don't expect anything else, right? That's what the industry has evolved into, where the race has been who can pay more and do less for real estate agents. So I know there are a lot of people that got into the business full of piss and vinegar, excited, enthusiastic about getting into the real estate career. Now they're a year or two into it, they realize that it sucks, and it sucks because they're the same as everybody else, same MLS that they're selling. They're doing it the same way, show the house till it's sold. They're networking, who doesn't know 9 real estate agents? So networking becomes less and less and less fruitful. Their companies aren't helping them. They're being told to use social media, so they're doing the best they can to find a way to build a business in a world that is totally the same, with the exception of the fact that they have less experience. So They've got to break into markets where other people have been for a decade and say, list with me. Well, how many listings have you taken in this neighborhood? You'll be the first one. No, thanks. I'm going to go over here to the experienced people. We're finding that a lot of people who are good, smart, motivated, but losing their motivation because they realize that it's actually a crappy job to be a real estate agent for a lot of people. They'd much rather be in the B2B side of single family real estate, where you're building a book of investor clients who buy a house. You make a commission. They then let you lease the house out. You make another commission. They buy another one 11 months later. You get another commission. They lease the house out. You get another commission. The first house comes up for renewal. You get that commission over again. The snowball effect of being able to have repeat buyers with residual income, and you're having a different conversation. So I hear people who are joining us saying, like managers of ours who never really recruited before, are reporting back that they're having fun because at least they're saying something that nobody else is saying, which makes saying it so much more gratifying and less painful.
Well, and the other thing is that compared to owner-occupied home sales, residential, retail, brokerage, I came from the commercial world, and the commercial world, and you know this, was about creating those relationships, those long-term relationships. And for example, the call that we did yesterday, to go unnamed who we're talking to,
they were my first commercial real estate client back in 2000. And now we're talking about deploying thousands of, acquiring thousands of homes for them. And the point is that the relationships you make in this world will take you a very long time. No matter what that client does, if they decide tomorrow to go into a different asset class of real estate, if I chose, I could work with them, because you create these relationships. And I don't have, there isn't 25 different agents, the person at their gym, and nowadays, most of the time, the home buyers, they're not going with they don't call an agent and say, I want to buy a house. They go look online, the bank, the lender calls them, they get that set up, and then they refer them an agent. So the loyalty is very low in the retail side, the residential side. On the commercial side, on the B2B side, you have a high amount of loyalty. I mean, look at us. We've known each other for a long time. We've come full circle around. We're working together because you create relationships on a business level, and that network lasts forever. And that's something that I've always tried to explain to a lot of our sales directors and new people coming in, is that you're building a network that will stay with you after you leave this company. And that is very powerful.
Are easier. It's easier to build relationships when it's also easy to add value to the relationship. It is not that easy to add value when you're one of 6,000 real estate agents in a market and everybody's kind of doing the same thing the same way. It's very, very difficult. And I grew up in the business. I love real estate agents. That's why I spent my whole career working with them and trying to lead and trying to support and develop tools and technologies and training and everything else. Anyway, I don't want to make this too much of a commercial that we already have. I just want people to know that the residential real estate industry is being attacked from both sides. You've got companies that are offering the super duper high splits, gutting real estate brokerages, but not really doing anything for the agents beyond the split. You've got Open Door, OfferPad, Zillow, Instant Offers, who are taking a chunk out of the business over here, that if you don't think that that's going to be 30-40% of the market in 5 years, then you're a cab driver saying that Uber won't work, right? So this is like, we feel bulletproof, because in our world, property management being the foundation of what we do, upon which we've now built a brokerage, and we're going to, we've got 200 agents, we want 2,000. On top of that, we've got the investor portal. So we're trying to be property management, brokerage, and investor portal. And now, the thing that we've been working on, you and I and the portfolio services team, is these large accounts. There's new players coming in, pension funds, insurance companies, deep-pocketed capital, the Prince of Brunei. These are large, the sovereign wealth funds are coming around with big capital. They want to allocate and diversify some into this new asset class. They're going to the other players that are already in this, the pioneers that paved the way. But as you know, because we're working with them, there's a whole new crop of clients that literally are 3 people in a conference room in Manhattan or Scottsdale that got their first $500 million committed. Now they got to figure out a way to deploy it. They got to figure out where to deploy it. So where? So they need data. They need analysis. They need experience. What to actually acquire, what channels to acquire from, and then who the hell is going to underwrite, convert, close, onboard, and manage these properties. We're looking to be the soup to nuts, because we can do that entire life cycle. But the whole industry around this, that if you're a talented person, think of second decade. That's what we call it here. The second decade of SFR is an entrepreneurial playground. It's a place that if, you don't have to have done this, because if you started tomorrow, you're like one of the first couple of thousand people that are actually even in the industry. So it's still so young that there'll be 50,000 people in it in 10 years, but you can still be one of the original players that are coming in and developing expertise. And, by 2020, this time next year, you can have more experience than virtually anybody in your market just by joining now.
Well, I have 2 comments on that. One thing is that this new money coming in, we've been talking, and I have for the last several years, to a lot of this new money, but the barrier to entry was so high because they were going to have to go to a fund. So they're basically a fund of funds. They were going to have to go to one of these big funds that had already executed this strategy, pay them a ton of their upside in order to do this. Now they can come to us, and they're not paying us any of their upside. They can be the 3 guys in a room and be that asset manager. And we heard this on the call yesterday, that, like if they could just manage the money, and let us do everything, then they'll do it. And we're
He
just
said he'd be happy. I think the quote was, "I'd be happy as a pig in shit if I could not have to leave the office suite in New York City."
Exactly. And the same thing. So that's interesting. And that's happening now. And we talk to these funds who are like, wait a second, we can actually do this. And until now, I mean, I'm not even saying, our company, even on the property management the last few years, we've been figuring out how to work at scale and be efficient and pass those efficiencies down, and the right reporting and the technology and all of that. And there's other companies like ours that are figuring out. The second thing on the agents, and this is something that when people would come work for me before, when I was buying the thousands of homes in Chicago, most agents will do 10 or 20 transactions in a year, maybe. You have the opportunity when you come work with us, especially on the PSD side, if you're already working in this, and that's portfolio services side, if you're already working in the SFR space, you have the opportunity to touch way more transactions and become an expert so much faster. I don't know if I always agree with the 10,000 hour thing or whatever, because it's different for each thing you're learning, but you have the opportunity to touch so much more and do so much more that you elevate yourself into an expert position so much faster. And on a national level and everything. So that's a big difference too. So any other thoughts? Yeah, I got to jump too. No, we have other things to do in the day, but thanks for jumping on, and we'll try to do these ad hoc stuff more often. I think they could be pretty effective because these are the conversations that we have anyways offline. So
so if anybody can get value out of it, then we would love that.
All righty. Talk to you later.
All right, thanks, Noel.
Yeah, you bet.
See you, buddy.
Bye.